Here to tell us what you can expect from the market until then are two guests with more than 40 years combined investment experience. They are Herb May, Managing Director with Signal Hill, and Mark Lucchini, who manages just under $1 billion as Chief Investment Strategist with Janney Montgomery Scott. To both of you, thank you very much for joining us today.
Thank you.
Mark, let me get to you first of all.
Sure.
I believe that you think QE2 could push more gains in the market and that it's not fully baked in right now. Why not, considering it's been so well telegraphed to the market?
Well, understand that QE2 has certainly helped put a bid under equity prices. Let's not forget that the fundamentals supporting equities are not unattractive at this point in time. Valuations are pretty reasonable. We've seen terrific earnings growth on a year-over-year basis and more expected for the same going forward out the next 12 months. Certainly in terms of the asset class derby, the stocks provide investors, I think, a reasonable opportunity for capital appreciation and in many cases an above market dividend yield when compared to things like bonds and cash that are yielding low single digits at best. That takes us back to equity. So on balance, I think stocks can continue to show advance even in spite of the QE2 in the offing.
Do you agree with that, Herb? Do you feel that not just QE2 but also positive fundamentals in the market are pushing gains?
Absolutely. Fundamentals seem to be good across the board. We got off to a great start with the earnings cycle last week. And expect that to continue this week with over 100 names in the S&P reporting. So Apple and IBM after the close. Plus, we're 2 weeks out from the election. So when we get some clarity, one way or the other, we get some clarity, that's great for the market. And we think that will bode well in terms of the IPO market, where there's a lot of pent-up demand for new issuance and expect that to accelerate into the end of 10 and on into 11.
Market has proven clearly that it can go up without the financials really participating. But the gains sure as heck look a lot better and stronger as a market, as the second biggest group of financials, when the financials are participating. Delivered today pretty good earnings from Citigroup. Do those now offset what's happening with the foreclosures? Bank of America just a short time ago came out and said that it's going to resume foreclosures in the next few weeks or so. Does one offset the other?
I don't know that they offset it, but what I would tell you is that the people love a good, strong financial backdrop, and clearly the earnings were supported by Citibank today. So to the extent that we get that out of other industry groups, technology, et cetera, I think that bodes well for the market in general.
Let me put it to you this way. Does it not, if it doesn't offset, does it trump what's happening with the foreclosure problem? The earnings from the banks matter more than what's taking place with the foreclosure situation.
Absolutely.
Yeah. What do you think on that, Mark?
I would tend to agree. I think there's a much bigger picture here at stake with regard to what financials are involved in terms of their portfolio businesses, not just domestically, but in the case of a Citigroup or a Bank of America on a global basis, really. So certainly the foreclosure issue is grabbing a lot of above-the-fold headlines, but nonetheless, in terms of the overall impact to earnings, I think certainly it'll be overcome by the better than expected news we're starting to see from companies that are seeing some improvement in their overall core businesses.
You mentioned, Herb, that fundamentals are driving the market. Isn't the movement in the dollar more than anything driving this stock market? And isn't that poised to continue? I mean, fundamentals, the data we got today, industrial production was weak. Market's up because the dollar's down.
Well, the anticipation,
which is, of course, tied into QE2, right?
Clearly. Anticipation of the QE2 is a weaker dollar makes the larger cap multinational names more attractive. They're always going to drive a return to equities first, and then followed by small and mid caps, which is a place where we spend a lot of our time.
Which really begs the question, because we're starting to hear people say that on many technical levels that stocks are overbought and the dollar is oversold. You don't buy into that at all?
Well, I don't know that isn't necessarily true. In fact, you could expect to see a counter-trend rally in the dollar, which might take a little bit of wind out of the sails of particularly some of the multinational companies. But fundamentally, the direction of the dollar seems to be pointed to lower ultimately. So that may be a near-term hiccup as opposed to necessarily being a permanent friction against what multinationals can continue to do.
So let's phrase this another way. At the moment, it seems to be providing a bit of a tailwind, having a weaker dollar for the stock market. At what point does it become a negative? At what point does it become a headwind?
Rising rates.
Most definitely.
Yeah.
Most definitely. I mean, the concern here, of course, is that with a weakening dollar, what are we going to have to do to attract capital to our marketplace and continue to support our treasury auctions? And a weakened dollar isn't the policy to do that.
We've talked a little bit here about how there's a perception that stocks may be overbought. There are those who make the argument that stocks are cheap still relative to the other asset classes, where we've seen this big rise in gold, big rise in treasury prices as well. You subscribe to that?
Well, I would say you've seen a tremendous amount of money flow out of the equity markets and into this sort of